What is financial behavior? You may be thinking that contradicts all my common observations and experiences in life, and you would be right. Nevertheless, classical economic theory is based on a world full of rational, informed, iron-willed, self-interested, consistent and efficient actors. There have been lots of studies in behavioral finance since the field took off about 30 years ago. The studies, almost astonishing in their variety, have attempted to find out how most people really act when making financial decisions, failing to realize that the loss of an unbooked gain really is a loss. Some investors only think it is a loss if their account falls below what they originally invested. They view an intermediate gain as not real, sort of like playing with house money. Sorry, it was yours, and if you didn't book it, you lost it. Failing to book a loss on a hopeless investment, hoping that it will come back. This is called loss aversion. People do not want to admit having made a mistaken investment. Apparently, people feel more pain from a loss than joy at an equivalent gain. They want to avoid regret over the loss, so they just don't book it. Not accepting a loss as the sunk cost it really is. This sunk cost fallacy keeps you focused on the past and diverts attention from what you can do now to get better results in the future. Selling winners too soon but holding losers too long. Forgetting that the real goal of investing is to build wealth as effectively as possible, not to justify decisions you've made in the past. This can lead you to fail to evaluate your current investments on their potential to produce gains from this point forward, which at any given time is the important question to ask. Becoming paralyzed by too many options. This inability to make choice under conflict leads to taking no action at all when action is called for. Ignoring long-run background odds in the face of more immediate or newsworthy information. For investors, the important background trend is that the stock market has returned an average of 10% to 11% since before the Great Depression. That's more than twice as much as the bond market. Obviously, an investor who is subject to any or all of the foregoing traits cannot be totally rational, even if he or she is trying to be. The sensible stock investor needs to be as rational as possible, because over time the stock market tends to reward rational decisions. That is, the market tends to move stocks towards their intrinsic values. For example, if you paid too much for a stock, over time the market will reduce your returns from that stock or even turn them into actual losses as it brings the price of the stock back to what it is really worth. Regretting the loss, failing to accept the sunk cost, holding on to the loser too long, failing to look ahead rather than back, and all resigned acceptance of the status quo obviously do not help you make the best decision in this situation. In the end, you want to apply your intelligence and objectivity to overcome self-defeating emotional tendencies in your investing. Left brain-based systems and processes can help you to do that.